Welcome back. Today's topic is private banking. To start with, let us understand what a private banking is. Well, private banking refers to a suite of services offered by a bank to high net worth individuals designed mainly to attract investments, tax management, and maintenance of their wealth for a fee. Unlike mass market retail banking, private banking focuses on providing more personalized financial services to its clients by assigning a relationship manager specifically dedicated to providing individual services. Banks provide their private banking clients with proprietary products that they keep confidential in order to prevent competitors from attempting to sell similar products. A bank may also offer discounted services to high net worth individuals as a reward for the large volume of business that they bring to the bank. Banks often allocate their best performing personnel to their private banking division. Typically, thresholds of private banking service are based on the amount of assets under management. Private banking also services need-based specific products or services like real estate management, closely held company oversight, and money management. The fees charged are ordinarily based on asset thresholds and the use of specific products and services. Since you now understood what a private banking is, let us now understand products and services offered in a private banking relationship. They are 1. Cash management services. Example, checking accounts, overdraft privileges, cash sweeps, and bill paying services. 2. Funds transfers or wire transfer services. 3. Asset management services. Example, trust, investment advisory, investment management, and custodial and brokerage services. 4. The facilitation of offshore entity services. Example, private investment companies, international business corporations, and trusts. 5. Lending services. Example, mortgage loans, credit cards, personal loans, and letters of credit. 6. Financial planning services including tax and estate planning. 7. Custody services. Going ahead, let us now understand the fee structure of private banking. Different banks charge their clients in different ways. Certain banks depend on the commissions they get by distributing third-party products. Other banks charges a fixed fee for certain products and advisory fee for the rest. Some of the other banks are totally advisory driven and charge the clients a percentage of assets under management or AUM. Example, 0.75% of entire AUM. The next question is, how do banks get their private bank customers? Well, the answer is simple. Their own customers who are giving businesses above a certain threshold are natural choice of customers who may be offered private banking. The source of such customers for private banking is lead generation. Meaning, leads or references for private banking are given by their wholesale banking, retail banking, and corporate banking divisions. Also, the other source of leads are existing client referrals. Meaning, a client would refer his or her friends when he or she is satisfied with the service provided by the private bank. Do you know that there is certain eligibility of private banking? Well, for most of the banks the minimum amount starts with $1 million. However, certain global banks requires an average daily balance of $250,000 or more to be maintained in their accounts with the bank. You should and must know that complex corporate structures such as private investment companies and other vehicles exist in private banking accounts. Hence, financial institutions have to put in place stringent policies and procedures for additional CDD for such structures. Handling of customer requests of private banking is another challenge faced by financial institutions. Financial institutions must establish the authenticity of all private banking customer instructions before acting on them. Authentication should be performed by parties independent of the front office, against the institution's official records. Financial institutions' authentication procedures typically entail the verification of customers' signature by independent parties. Callback procedures are also generally performed by parties independent of the front office, using customers' contact numbers maintained in the financial institution's official records. Do you know what is a hold mail? Well, Hold mail is a request to the bank to retain all correspondence, statements, and written documentation or advices. The customer can collect these communication by visiting the branch personally. Hold mail facility is generally given to private banking customers who mostly travel. The private banking accounts with hold mail services are more susceptible for abuse. Since customers receive the account statements on a delayed basis, this creates opportunities for misappropriation of assets and other irregularities to go undetected. The other risk in private banking business is inactive or dormant accounts. They are exposed to increased risk of misappropriation. Such accounts typically receive minimal or no notice from their holders. Unauthorized withdrawals from such accounts could thus escape detection if proper controls are not in place. Lastly, let us understand the money laundering risks of private banking. 1. The customized services provided via private banking include high-value transactions, use of sophisticated products, such as structured products. Services help to conduct business across different jurisdictions, especially offshore and overseas companies, trusts, creation of personal investment vehicles, etc. are all conceived to be mediums of money laundering. 2. International banking services has spread across its wings even to jurisdictions with weak money laundering controls, hence, the origins of wealthy clients are difficult to verify, thus, giving ample opportunities to money launderers in a way. 3. The close relationship that private banks aim to have with their clients enables criminals to launder money themselves by understanding the loopholes in financial system. 4. Since private banking services are privatized in nature, the banks may lack means of monitoring customer transactions, including a robust independent process for querying and investigating unusual activity on accounts, leading to more money laundering. 5. The significant amount of money that relationship managers earn due to maintenance of the high net worth individual's investments commission, it is quite likely that they will report any wrongdoing of their clients knowing that they are also part of the crime and indirectly laundering money for their clients. 6. During initial due diligence or periodic review of private bank clients, usually some important aspects of questions either gets missed or misled by relationship managers, or an exception is approved because the client is bringing huge investments, hence, encouraging money laundering indirectly. 7. Private banking take reliance on introductions. Example, clients who were introduced to the bank by known professional advisors in that country. It is likely that complete enhanced due diligence is either missed or the clientele relationship itself is either considered medium or low. 8. Relationship managers usually justify all the transactions of their clientele knowing the loopholes of the bank, hence, resulting in low volumes or nil suspicious activity report being reported, encouraging money laundering. That's all for today. Thank you. Hope you all now have a fair idea about private banking business and you may now apply this knowledge to your day-to-day work. Have a nice day ahead. Stay tuned.